ChargePoint continues to be one of the most confusing stocks in the market. I think not because most people don't understand what an electric vehicle charger is, but because most people don't understand what ChargePoint actually does. The company does not make electric vehicle chargers. In fact, they just announced a partnership with LG that's going to push most of that design and development of the charger itself to LG. What the company actually does is the software behind the vehicle network, and that is losing money like crazy. So the question is, with the stock down 79% in the past year, is this the kind of company that can improve those operations, actually get to profitability? Or is this a lost cause in the electric vehicle market? And I say this with the backdrop of electric vehicle sales growth is slowing. So the number of new vehicles hitting the road maybe isn't what people expected. North America in particular has moved to a standard plug. The North American charging standard is going to be on most vehicles starting next year. So that's going to commodify and standardize the plug itself. You're delivering a commodity, electricity, through that plug. So what value is there in the network when one company or one car can just plug into multiple different networks? I'll show that again with an agreement that was recently announced with Porsche. ChargePoint is a company that is what it says it is. It is a reseller of other people's electric vehicle chargers, and it is a network with no network effects. So with that context, I want to look at a couple of recent announcements and show why the financials are so weak for this company. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with a description that tells exactly what the networked charging systems are for ChargePoint. And the context here is that I think most people think that ChargePoint makes their own chargers. There's something new or unique about their chargers, but that's not really the case. ChargePoint uses contract manufacturers to manufacture networked charging systems, simply electric vehicle chargers. In fact, they recently announced a deal with LG that will actually have ChargePoint reselling LG's chargers on a commercial side. It says the first output of this relationship will be commercial charging solutions that encompass ChargePoint's industry-leading charger management software and LG's advanced EV charging hardware. So LG is going to be the hardware company. ChargePoint is going to be the software company. Deliveries are expected to begin later this summer. So why is this something that's important to know? Well, if you look at ChargePoint's financial results, you can see that in the last 3 months, this is as of April 30th, 2024, $65.4 million in revenue from selling electric vehicle chargers. Those chargers cost the company $61.1 million. So very, very low gross margin for simply reselling somebody else's charger. What did it cost to make those sales? Well, we don't know exactly, but sales and marketing expenses, $35 million. R&D, $36 million. So maybe they'll be able to reduce that in the future as they're working more with LG. And then general administrative expenses. So at least a chunk of that operating expense should be attributable to electric vehicle charger sales, especially being this is about 60% of the company's revenue. Now, the subscription business should be where the company does a little bit better, makes a little bit more money. And you see that right here, $33.4 million in revenue, $17.7 million in expenses. So that is a positive gross margin, but again, nowhere near enough to offset the operating expenses for the business. So this is really what you would like to see growing: subscriptions, basically software sales. This is where the network effect would kick in if there's a lot of value in the network. But a recent agreement with Porsche really highlights that there's not a lot of network effects here. And there's a similar agreement a couple of years ago with General Motors, where General Motors announced that 6 or 7 different electric vehicle networks were going to be joining their GM network. So the customer actually interacts with the GM network, they pay the GM network, and then that network pays ChargePoint for the electricity and the charging that they provide. Same thing is going on right here with the Porsche Cars North America. It says that this will enable PCNA access to the ChargePoint network within the Porsche charging service. So again, the customer is actually going to interact with the Porsche charging service, and then ChargePoint becomes basically a commodity supplier to that service or that network. So this is where there's not a lot of pricing power. So if there's not a lot of growth, and there's not really good margins on electric vehicle charger sales, and there's no pricing power in that network and software side, what value do you have from ChargePoint? Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now we see this exact same challenge from Blink Charging, one of its bigger competitors in public markets. And really, I think this is going to be something that's going to be common across the electric vehicle charger business. It's just going to be really hard making money selling a commodity through a standardized or commoditized plug, unless for some reason there is just way more demand for electric vehicle chargers than there is supply, which I just don't see being the case anytime in the future. And that's how you get to charts like this. This is the company's operating cash flow, that's in orange, and free cash flow in blue. You can see that as ChargePoint has gotten bigger, they have actually been burning through more and more cash to simply grow the business. Now, why is this a challenge? Because there is now $262 million worth of cash on the balance sheet, offset by $285 million worth of debt. Combine that with the falling stock price that you have now trading at $1.65 per share as I'm recording, and your financing options to finance that negative cash flow in the future just gets worse and worse by the day. So if there was some sort of value at the end of the rainbow, at the end of building out this network, that's something that the market may fund on an ongoing basis. We have seen that in the past with companies that have network effects or two-sided markets, but I don't think there's any real valuable network effect or two-sided market in the case of an electric vehicle charger. And when you look at the fact that ChargePoint can't even make a significant profit on the chargers that it is reselling that someone else manufactures, and it doesn't have scale in the business from a networking or software side, this is just a business that I think is really in a lot of trouble. It's going to probably need to be restructured to get that cost structure in line with what's more appropriate for the market. And the next big challenge is going to be, where are they going to get cash when they need to raise cash in the next year or two? As the stock falls, it's going to be harder and harder to raise cash from equity markets. If you have a very low stock price, it's going to be very difficult to raise money in debt markets because interest rates are going to be high, or conversion is going to be high if you try to do convertible notes. All of these are really bad options for ChargePoint. And that's just what I see as an unsustainable business model for ChargePoint. So the stock is down. Yes, maybe that looks a little bit more attractive compared to where the stock was trading before, but don't price anchor on previous prices. Look at the business. Is the business profitable? Is it growing profitably? Is there something that's going to create a flywheel or a network effect to actually improve margins in the future? I don't think any of those things are going to be the case for ChargePoint. That's why this is a stock that I'm staying away from. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.